Hey everyone, welcome to the KE Report in a daily editorial on Monday, October 6th, chatting with Craig Hemke. It's been just under a month since we last chatted with Craig, and well, Craig, it's been up, up, up for precious metals and the precious metals stocks. Some of the data I have here just for this year. Gold is up 8 out of the last 9 months, up almost 50% this year. Silver is up over 60% this year, but I think even more importantly, just from June through now, up about 45%. Really, it's just gone parabolic over summer. GDX, that's up 125% this year. That's up 9 weeks in a row. Craig, it's good times for the precious metals sector, the metals and the stocks. What are you seeing out there? Historical references and some of your expectations in terms of really a historic run?
Well, hi guys. I hope you have been well, and it's a pleasure to visit with you again. Yeah, we have had a heck of a month. From the last time we spoke to now, it has been quite fun. And I would suspect there is still fun to continue, particularly in the shares. Dips have been bought for the last week or so, and I would think there will probably continue to be bought ahead of third quarter earnings, which I mean are just going to be spectacular. And I know a lot of folks are like, you mentioned those numbers, Corey. I mean, it's just unbelievable. Not only what the ETFs have done, but so many individuals. Oh, CDE has gone from 2 to 18 or something like that. It's crazy. But I'll just regarding the shares and how much further they could go, as these companies are making so much money. Combined market cap of the six biggest stocks, not the Mag 7, we'll just call it the Mag 6 in this regard, is $20 trillion. 20 trillion is the combined market cap. To give you some idea how much money is out there, investable assets, $20 trillion in just six stocks. If you carved off 1% of that market cap, 1%, that's $200 billion. The entire GDX, the entire thing, has a market cap of 20 billion. So if you take 1% out of the Mag 6 stocks, you could buy 10 GDXs. So where all of those companies have just, they're just exploded. And however you want to measure the valuation, if we're right about where the price of gold is going, and why wouldn't we be, given that the math is the math, then the shares have a long, long way to go before they're overextended or should be considered a bubble or anything like that. Regarding the metals, and I'm already filibustering this a little bit. I don't know. You guys probably remember. I don't know if anybody listens to us every week, but back when gold went sideways from April the 22nd all the way until the end of August. So it was about a 4-month consolidation, continuing a pattern that it has been traded ever since it initially broke out to new all-time highs in March of last year. You get this sideways consolidation from either 6-8 weeks out to this most recent one that was 4 months, and then upon a breakout, a 15 to 20% rally. So when we broke out back at the end of August, it was logical to expect, okay, here comes another 15 or 20% rally. And that's all that's happening. It's not in a bubble. It's not going parabolic. It's just the next stage of the rally. And I would lastly remind everybody, gold is not like a stock that goes up and gets overpriced or, whatever. There are all kind of valuation things that you put into any stock that you might own. Tech stock, whatever. The PE multiple, what the earnings are, the book value, whatever, right? And you could then justify or make an argument about something being expensive. Gold is gold. Gold doesn't change. It's just a measuring stick. And so you can't say that it's expensive or anything. All that's happened is it took 1,100 US dollars to buy an ounce of gold 10 years ago. It took $2,200 to buy an ounce of gold 5 years ago. It takes nearly $4,000 to buy an ounce of gold now. And 5 years from now, it'll probably, following that progression, $6,000. It's not the gold that's changing. It's the purchasing power of the dollar. And as long as that continues to erode, the gold price is going to keep going up. The gold miners are going to keep booking larger and larger profits. And now we're back to where we started this answer. Boy, that was a long one.
Well, it's a great point, Craig. The gold is not changing. It's on the elemental table, but it's not just the US dollar terms that it's at all-time highs. It's at all-time highs in all fiat currencies because all fiat currencies have that counterparty risk, and they're in a race to the bottom. So whether you're looking at the Canadian dollar price of gold, which is eye-popping, or the Australian price of a dollar price of gold, it's up across the board because you're right. What's changing is the purchasing power of currencies is going down, and gold is the measuring stick. Now, silver is a little bit different in that it's not quite the same animal. It's still a precious metal. It's a hybrid metal, part industrial, but it's not being bought by central banks. Well, there's a few central banks that are buying silver, but not most of them. And it holds a different space in the sector, but it's had quite a rip. And as Corey mentioned, just really since the summer, it's really hit the turbojets. That usually happens as the bull market gets, more into the mid stages. And we're getting close to that magical $50 level here as we record this today. It's in the mid 48s, but do you think it'll blast through 50 and just blow everybody's mind? Do you think that 49 to 50 has a lot of pricing resistance, going to cap it? Where do you think is going to happen with gold's little brother, silver?
Shad, you ready for another long answer?
Of course.
All right. First, again, I'll go back to our conversations back in the summer. Remember, we talked about silver and what is it? Newton's law of motion. Remember these discussions? And how silver will just sit there and sit there and sit there. And then once a force is applied to it, it gets moving and then it generates its own momentum and off it goes. And that's what has now begun and is underway in silver. It sat there and sat there. And then once it starts taking off, you get this FOMO trade that kicks in and, it just builds its own momentum. There's also some serious structural problems within the global silver market, whether it's the 700 million ounces of supply deficit the last 4 years, the ongoing relentless demand from China and the East for physical silver, the electrification demand. But now throw also in that, like that massive mine in Indonesia that had that collapse 2 weeks ago. There's the largest copper mine in the world, but also the largest gold mine in the world, which by extension probably makes it the largest silver mine in the world too, because silver is usually a byproduct of those two. And you've got all kinds of potential supply disruptions on top of a booming demand picture. So again, you got this FOMO, profit chasing, building its own momentum in the futures market, but there's an underlying physical component to this that suggests there's probably no reason to think that silver won't see new all-time highs as well. Regarding price, there's a lot of people out there, I guess, that want it to shoot higher and go to the moon. And I'm one of them. That'd be great. But that's not how I expect that things are going to play out over the next few months. Silver probably tag its old all-time high, which is up like 49.60 or 70 in the front month futures contract. So it's got another $1.50 to go or so. It's going to run into some resistance and then probably consolidate in that same kind of pattern like gold has. I'll just remind people, I think this is not 2011. Okay, it's a whole different world. And so I think the situation in silver is not analogous to 1980 or 2011. Okay, the price is, but the situation is different. And I think the situation in silver is much like gold when it finally broke out in March of last year. Gold had gone up, to 1920 in 2011 and gone up to 2000 and change in 2020. And then it went sideways for 4 years. And finally, on the 1st of December in 2023, it started to break out. It turned around and reversed. It then spent 90 days, all the way to March 1st of 2024, going sideways, trying to break out. All kinds of people were worried, oh yeah, here it comes. It's going back to 800, and all this kind of jazz. Instead, it broke out on March the 1st of last year. And then once it broke out, it's been on. What's 2100 to what? 3900 is what? 75%, 80% rally in the last year and a half. So I would suspect silver is going to do the same thing here. It'll go up to 49 or 50 and then be rebuffed a few times and go sideways for weeks or a couple of months. And then as we get into 2026 with the incredibly bullish news I think is coming, I think then it breaks out. And if gold can go 80% in 18 months, why can't silver? And by late 2027, we might be talking $80 or $90 silver, which wouldn't surprise me at all.
Craig, let's talk COT reports then. I was asking you off mic, and you reminded me that the government is still shut down in the U.S., so we won't be getting any current reports on that front. But have you seen anything in the recent ones before the government shut down that says one way or another just if traders are overpositioned or overextended in one direction?
No, actually, would be the answer. The most recent one that we got for the week Let's see, it was surveyed on the 23rd of September. And again, we're not going to get one now for a long time. Remember the last time the government shut down like for 6 weeks? And I mean, they just played catch up at the end. And we started getting caught reports like every 3 days. And finally, I don't know, a month after the shutdown ended, we were finally, anyway. So don't be looking for any. I mean, the latest thoughts are the shutdown could last at least another 3 weeks. So don't be looking for any caught data, but also don't be looking for the jobs report that we never got last Friday. We'll be due for a CPI and PPI next week. Well, that comes from the BLS as well, so that ain't coming either. Durable goods, retail sales, all that stuff. None of it while the government is closed. So maybe we don't have to worry about it. Anyway, back to your COT report question. As of the 23rd of September, if you just look at it on that legacy report, the large speculators, if you will, in gold, we're net long about 267,000 contracts. You might think that's a lot, but as recently as the end of January, they were long 300,000. You know, I mean, what's price done since the end of January? It gone up $1,000? And the same thing in silver, the net long position of the speculators, the hedge funds and the like, in silver, as of the 23rd of September, was 52,000 contracts net long. Again, that sounds like, oh boy, watch out. But they were that long in February. They were more than 60,000 net long in June, 66,000 net long in the middle of June. So again, is it heavy? Is it due for a no, not really. I'll just put it this way. If someone that says that somehow the futures market are in like a bubble or a speculative, thing waiting to burst, they're ignorant of history. I mean, the total open interest in COMEX gold as of Friday, 491,000 contracts. It's been as high as 800,000 a couple of years ago. So that's not what's driving this. This is not like some big bubble, of hedge funds getting ready to just, flee to the exits. It's totally different than that. And that's, again, these are all important things for people to understand, to kind of keep their wits about them and not get faked out. Let's invest, let's hold for the long term and just see where it takes us from here.
It's a great point, Craig, and I don't know how we're going to survive without all these government reports, but somehow we'll make it through it. But let's shift over to the precious metals equities. As Corey mentioned at the onset, GDX up in a big way, 125%, GDXJ, SIL, SILJ, and you made a great point about core mining going from 2 to 20 almost a 10 bagger here. Now, we have just closed the month of September. We didn't get to talk to you at the end of September, but the highest average quarterly price of gold and the highest average quarterly price of silver, by the way, that we've ever seen on planet Earth. So for these mining stocks that are producing gold or silver, they're going to have record revenues. I ask this every quarter, but I got to ask you again, Craig, do you think that these forward assumptions in the market, the forward-looking markets, have already priced into Q3 earnings with the pricing we're seeing today in these stocks?
I don't. But again, it's just such a relative question because that's kind of a beauty in the eye of the beholder sort of thing. Because some people might look at that and go, oh, yeah, I can't believe it. Others might look at it and go, yeah, but they're just printing money and paying off debt and all this kind of stuff with the buying back shares and increasing the dividend and all these kind of things. I'll remind you too, in case people don't watch crude oil close enough, crude oil's down there like $65 a barrel. So what's the largest cost that these mining companies have besides, some of them bloated HR departments is energy costs. So their margins are just getting wider and wider. The GDX is doing great, but I remember back at the first of the year, and at the end of last year, I even dedicated a part of my forecast for this year to this. You can buy the GDX, and obviously 127% year to date or whatever. That's a pretty good deal. But there are still mining companies out there with significantly less all-in sustaining cost than their brethren. And that's still the place that probably, to me, suggests those companies are bargains. So anybody that's listening, yeah, you can just ride that ETF if you want to go lazy about it. And 127% is nothing to sneeze at. But if you want to be a little more selective and kind of guard yourself against downturns or buy stocks on the dip, do some research. Find out the ones that still have all-in sustaining costs below $1,100, an ounce. And you start looking at it and you're like, oh my God, they're making $2,500, $3,000 on every ounce that they pull out. It's remarkable. So the value is still there. Again, getting back to where I say that, Shad. But it's all kind of in your own perception and your own risk tolerance and, where you think the price is headed.
Craig, with these developers or the producers that are making so much money, and quite frankly, all have gone higher, when you talk about finding the lowest price or the lower price producers, does size matter then? What size are you looking for that you think actually moves the needle?
Yeah, again, I got to go back to what I wrote about in January. I think you've got to find kind of the mid-level. That I've always thought was the sweet spot because they might be producing 100,000, 200, 300,000 ounces a year. But because they're smaller, they really generate the bang for the buck. It's like I read something last week. Does Franco-Nevada only have 43 employees? Do you guys know that?
Yeah,
Something
it's
like
a
that, a couple
royalty
dozen.
company. They
Yeah,
are not, they don't have many costs, those royalty
right.
companies.
43 employees. I mean, well, no wonder that stock, all it does is go up over time. Wheat and precious metals probably the same way. So again, I just think there's value in, listening to you guys. I've got friends that do great job of writing newsletters, and understanding, grams per ton and what it all means and companies that do manage their costs. I think there's great value if you're going to be in the sector in gaining that expertise at a cost. The only other thing that I would point out that I do think is interesting in all this is, and again, maybe this buttresses the notion that we're not in some kind of bubble yet. I sure would have thought if you'd have gone back 2 years ago when gold was, at this time of the year, $1,600 and said, Craig, don't worry, man. By October of 2025, we'll be talking $4,000 gold. I'd have thought the Toronto Venture Exchange would have exploded and all my little small cap stocks, would just be going wild 5 and 10 times higher because we always just talk, oh, it's not economical at $2,000, but at 4,000, holy cow. And obviously that hasn't happened. So maybe this is also a case that we need to use this time if you have had a run up in some of your explorers to review where they are, and whether they are an actual potential takeover candidate, because of their proximity to some big companies producing mine already that they might want to expand their operations, or whether they are in a place where the infrastructure is solid enough that if they don't find somebody to take them out, they can just say, "Oh, to hell with it. We're just going to start it ourselves." But if you're out in the boondocks, with measured and indicated in the ground, and no, I mean, if it's not going up at $4,000 gold, the market's probably telling you it's not going up at 5,000 either. So this might be a chance to kind of revisit your portfolio if you play in that sandbox.
Well, Craig, just to that point, there are projects that have been on the sales rack the prior two cycles, back in 2011, the 2016 run, the 2020 run. They never seem to get built. And here we are closing in on 4,000 gold, and some of these things are still not getting built. So to your point, that may be a warning flag for people. If you're not going to build it now, when the heck are you going to build it? But it's also not stopping those stocks from actually going up. A lot of those are up 3x, 4x, 5x during this period. So it's very difficult for investors to ascertain what's real, what's not. But I got a question for you about the ounces in the ground and where they're being valued. We still look at companies that are being valued at $30 to $60 an ounce in the ground, maybe some of them getting closer to 100. Look at the margins you just talked about. The margins for these producers are over $2,000 in many cases, and yet we're only paying the companies that are developing the next batch of resources, getting the next batch of cookies ready to bake. We're only going to pay them $80 an ounce in the ground, $60 an ounce in the ground. Do you think that there's some kind of a wild, mispriced of the development stage companies in the sector based on where gold prices is and based on where their economics are?
You can certainly make that case. I wonder if there's just some specifics involved, like these big companies I mentioned earlier, increasing their dividend and buying back their stock rather than paying, $500 million for some company that's in their neighborhood that's got all this resource in the ground. I mean, instead of buying that and trying to increase, their how things look down the road, they're instead pumping up their dividend and buying back their stock. And that's kind of symptomatic of the stock market in general, right? Because all these CEOs are trying to manage into the next quarter. I mean, not just in the mining sector. I'm talking tech, healthcare, everything else. Everybody's so focused on just the next quarter and hitting your numbers that You're not maybe necessarily looking over the horizon as to where you're going to be 2, 3, 5 years from now, especially if you're a mining company with depleting resource. So it is curious as to why there isn't a bigger M&A at this point. But and again, this requires expertise that I don't have. I freely admit it. But you got to look at each individual company, and it's one thing to have it in the ground. It's another thing entirely to get it out of the ground. And if you're out there in the mountains and, it's 50 miles to the closest road and there's no electrical wires, and all that, how are you going to get a mill in there? How are you going to, you know what I mean? So there's some economic reality that plays into each of these things too. There's great potential. Don't get me wrong. And we'll continue to play in this sector. But when you get at, this kind of thing where we are with price, if your company isn't really moving, there's probably a reason why. And it might be a good time to kind of reassess your holdings.
Yeah, well, very few of these stocks are moving higher, let alone 2 to 3 to 4 times higher. So even those stocks that maybe have doubled, they are actually lagging this market. So that's something to consider. And to your point about who's going to buy it, Craig, we do have less majors out there, and they're just not as aggressive right now as they were at the peak of the last major bull market about 15 years ago. So that could be another reason, but fact of the matter is these stocks are moving. Even the explorers are moving. I know you focus a bit more on some of the larger companies, but undeniably we all get sucked into some of these smaller micro caps, and they, almost all of them, are also moving very strongly, some off the back of almost no news other than raising money. So how do you go about analyzing these junior companies that are also re-rating but are so dependent on news flow, at least moving forward and validating their story, that you are opening yourself up to a lot more risk?
Again, I mean, we're kind of getting down a road that is not my level of expertise, but a rising tide, maybe just a rising tide lifts all boats, right? Maybe it lifts some boats faster than others, which that can be your measuring stick as to whether you're in the right ones or not. And the last thing I'd add, Corey, is something that you said just a second ago. We're not seeing the level in M&A that we saw at the peak of the previous bull market back in 2011, which you're correct. That also implies that we are not at the peak of the current bull market, perhaps. So just something to think about.
Well, Craig, just to that point, what does the peak of this bull market look like if you project that out? Because there's already people that are starting to trim positions or even sell some of their gold and silver. Obviously, people are looking at prices a lot higher. We're starting to see the price forecasts come back out of the woodwork that don't sound so crazy this time of, 5,000 gold, 10,000 gold, 12,000 gold, $100 silver, $200 silver. We're starting to see those forecasts, and they're not without, some basis on it actually could be playing out. But for you, what does the end of this cycle look like where you would actually ring the register?
Well, we're not anywhere near that. Again, ringing the register, especially when it comes to where I focus my attention, the physical metal. I've never sold an ounce. And again, when you sell your metal, you are exchanging your metal back into whatever currency that you're accepting in exchange. Well, why the hell would I want that when I'm so confident of the math and the ongoing destruction of fiat currencies and within this debt-based monetary system? As it relates to, trading, that sort of thing, I mean, we've gone on a long time. I don't want to just drag this out, but I swore off the mining shares in about 2012, 2013. I can't remember. Didn't own a single one. And then I had a company I used to work for offer me a present value buyout of a defined benefit plan, and they sent me $55,000. I was like, okay, what the hell? And I took that $55,000 and rolled it into an IRA, right? Which is what you do, because you don't want a tax situation. That was November of 2015. I mean, at the lows, right? January of 2016 was low. That 55,000 as of last week was 300,000. And all I've ever done, I mean, I've changed a few things. How about Franco-Nevada, even back then, and held it forever until I sold it last year when the Cobre Panama thing happened and I switched to Wheaton. Anyway, I digress. I've just bought and hold and held because, again, the math is the math. It's never going to be straight up. I mean, it's just not. I don't know. I suspect gold and silver are going to consolidate again for at some point here, starting shortly. And then we're going to get into 2026 and we're going to be talking about yield curve control and a new Fed chair and all this kind of stuff. And we're going to get another big, huge rally. Well, I don't want to miss that. And for the sake of, well, I don't want to, 5 or 10% drawdown. I've managed those for 10 years now. So I have no intention, obviously, of selling any physical metal. And I just stay invested because I'm confident that my long-term thesis is correct.
Well, Craig, we'll wrap it up here. So far, that long-term thesis, boy, oh boy, is it playing out this year, especially for the stocks. And look, we'll keep asking the questions of what a top looks like, but right now, as we're seeing gold move up 30, 40, $50 a day, and silver sometimes well over $1 a day, momentum is still on the precious metals side. We'll see how long it lasts for and continue to celebrate the wins. And also, hopefully, everyone is still focused on some of those higher quality stocks to limit any downside when it will come, because there will be pullbacks. We just haven't gotten one in a long time. Again, Craig Hemke, founder and editor of TF Metals Report. Click that link in the show notes to follow along with Craig. Craig, as always, thanks for your time today.
Guys, it's always fun. We'll talk to you next week.